Most of the payroll problems I see don't look like problems. That's what makes them expensive. The paychecks go out. The direct deposits land on time. Nobody's calling to complain about the math. And every single one of those things being true tells you almost nothing about whether the business is actually exposed. I'm John Harman with Harman CPAs and Associates. We work with business owners on tax planning, and payroll sits right in the middle of that E. Because a lot of the exposure I see doesn't come from the tax return. It comes from what happened all year, one pay period at a time, in a process most owners have never had explained to them past the basics. So before we get into where the risk actually hides, I want to start with the plainest version of this there is. What actually happens to the money between the moment you run payroll and the moment it lands where it's supposed to, because almost everything else in this video builds on that one distinction. Let's get into it. Every time a business runs payroll, more happens than just cutting a check. Start with an employee's gross wages, the full amount they earn for that period. Before that money ever reaches them, a business withholds several things directly from it. Federal income tax, based on what the employee elected on their W-4. The employee's share of Social Security and Medicare together, what most people call FICA. In some states, state income tax as well. What's left after all of that is withheld is net pay, the number that actually shows up in the employee's account. But the business isn't done at that point. On top of what was withheld from the employee, the business owes its own separate share of Social Security and Medicare, an equal match to what the employee paid in. And the business owes federal unemployment tax, along with state unemployment tax, calculated on its own separate schedule. All of that, what was withheld from the employee and what the business owes on its own behalf, has to be deposited with the government on a set schedule and then reported through quarterly and annual filings that summarize what was paid and what was withheld across that period. Here's the distinction that everything else in this video is going to come back to. Not every dollar in that process is the same kind of dollar. The employer's own share of taxes, the match, the unemployment tax, that's a business liability calculated after the fact, the same as almost any other business tax obligation. But the money withheld directly from an employee's paycheck, the federal income tax, the employee's FICA shares, was never the business's money in the first place. The law considers that money held in trust for the government the moment it's withheld. It just happens to sit in the business's bank account for a short window before it's deposited. That difference sounds technical. It isn't. It's a difference between an obligation the business owes and money the business is only holding. And it's the reason the next several things I'm going to walk through don't behave like a typical business expense. Once you see payroll this way, as gross wages, withholding, deposit, and filing, with one category of that money never actually belonging to the business, everything else about how this can go wrong starts to make a lot more sense. That distinction, money the business owes versus money the business is only holding, is exactly why the next part of this doesn't behave the way most owners expect. It starts with the protection you thought your business structure gave you. If you formed an LLC or an S Corp, you probably did it, at least in part, for the protection. That's the whole premise most business owners operate on, and for good reason. It's real. If a client sues over a contract, if a vendor relationship falls apart, if the business takes on debt it can't repay, that exposure is designed to stay with the business. Your house, your savings, your retirement account, all of that is supposed to sit outside the reach of whatever goes wrong inside the company. And for almost every category of business debt, that protection holds up exactly the way it's supposed to. There's one category where it doesn't. When you withhold federal income tax or an employee's share of Social Security and Medicare from a paycheck, that money was never the business's to begin with. It was collected on the government's behalf and held briefly, waiting to be deposited. The IRS doesn't treat that the way it treats an unpaid invoice or a defaulted loan. It treats it as money that was already collected and simply never handed over, which is a different category of problem entirely, with a mechanism built specifically to reach past the entity and land on the person. That mechanism is called the trust fund recovery penalty, and it's not a business debt at all. It's assessed directly against an individual, someone the IRS determines had the authority to decide which bills got paid and who willfully chose to pay something else while that deposit sat unpaid. Willful sounds like it should require some kind of intent to defraud the government. It doesn't. Choosing to make payroll on Friday and telling yourself you'll catch the deposit up next week is usually enough to qualify, which means most people who end up facing this penalty never set out to do anything wrong. They just made an ordinary cash flow decision during a hard week, the same kind every business owner makes at some point, except this one happened to touch the one category of debt the law treats differently. And here's the part that catches people even more off guard. This liability doesn't require you to be the owner. It reaches anyone with real authority over which bills got paid, a controller, a bookkeeper with signing authority, a manager who stepped in during a rough stretch. More than one person can be assessed the full amount for the exact same unpaid dollar, not split between them, each one individually on the hook for the whole liability until it's satisfied by someone. This isn't a rare enforcement action buried in the tax code. In the most recent fiscal year on record, the IRS assessed more than 4 million employment tax penalties, totaling close to $27 billion. That's not a handful of outlier cases. That's what happens when an ordinary cash flow decision meets a penalty structure this specific at this scale every single year. And the exposure doesn't go away quickly either. The IRS generally has 3 years from the filing date to assess the penalty and 10 years from assessment to collect it, long enough that a rough quarter from years ago can still surface as a personal liability well after the business itself has stabilized, been sold, or closed entirely. Corporate bankruptcy doesn't touch it. It was never the corporation's debt in the first place. Your entity was built to keep business risk on one side of a line and your personal assets on the other. This is the one liability that was designed to cross that line on purpose. And it doesn't ask whether you meant for it to happen, only whether the deposit went out. That exposure follows the person, not the entity, and it comes from a decision made under pressure. The next one follows a decision just as personal, except this time it's a decision about someone else, who you decided was a contractor, and whether the law actually agrees with you. Most businesses that bring someone on as a contractor treat the decision the way they'd treat any other hire. You issue the 1099. You file it at year end. As far as most owners are concerned, that settles it. Here's what the form doesn't actually decide. A 1099 tells the IRS how you categorized payment. It doesn't tell the IRS or anyone else whether that categorization was correct, whether someone is properly a contractor or an employee isn't something a business gets to decide by agreement. It's a legal determination based on how the relationship actually functions, and it can be reopened at any point during or after that relationship, not by you, by the worker, by a state agency, by an auditor who was looking into something else entirely and happened to notice the arrangement along the way. The test itself comes down to a few consistent questions. Who controls the schedule and the method of the work? Who provides the equipment? Whether the person is free to work for other clients or works exclusively for you in a way that starts to look a lot like employment. No single factor decides it on its own, but the more control a business exercises, the more the relationship looks like the thing the label says it isn't. Here's where it gets more complicated. The IRS applies its own version of this test. The Department of Labor applies a different one. A number of states apply a stricter version still, one that assumes employee status unless the business can prove otherwise on every point, which means the exact same worker doing the exact same job can be correctly classified under one standard and incorrectly classified under another for the same day, the same relationship simultaneously. And when that gets challenged, it doesn't just get corrected going forward. The review reaches backward. Across every year, the relationship existed under the original classification. A contractor treated that way for 3 or 4 years, later determined to have actually been an employee, generally means the business owes the employment taxes for the entire period, not from the date someone noticed. There's a real world scale to this worth naming. A national delivery company settled for over $200 million in California after more than 2,000 drivers were found to have been misclassified. And the exposure in that case went beyond back taxes into wage claims and benefits that should have applied the whole time. Most businesses aren't operating at that scale, but the same mechanics apply to a single long-term contractor relationship just as easily as they apply to thousands. It just takes longer to notice because there's only one relationship drifting quietly instead of 2,000. Here's the part almost nobody I talk to has ever heard of. There's a program, the Voluntary Classification Settlement Program, built specifically for a business that wants to correct a misclassification before any agency ever raises the question. Qualify, and you pay a fraction of what a full correction would cost at a reduced rate with no interest and no look back audit of the years before. But the window only stays open before any government contact begins. The moment an audit or an inquiry starts, that option disappears completely, and you're left facing the full exposure with no reduced path available. A contractor relationship that started out genuinely independent can drift into something else over 2 or 3 years without anyone deciding that on purpose. The label on the form never moves. The relationship does, and the only version of this that costs you almost nothing is the one you catch before anyone else does. Both of those risks come from a decision made once and never revisited. The next one is different. It doesn't come from a decision you made at all. It comes from someone else asking your payroll a question it was never built to answer. If your payroll is accurate, checks go out correctly, deposits land on time, nobody's complaining, you have every reason to feel confident about it. That confidence is earned. It's also incomplete because 2 of the reviews a growing business is most likely to face. Don't ask whether your payroll was accurate at all. A standard payroll process is built to answer one question with precision. How much did this person earn and what got withheld? For running payroll and meeting basic filing obligations, that's exactly the right data. But a workers' compensation premium audit asks a completely different question. Not how much someone was paid, but what kind of work they actually perform, because the premium a business pays is tied to risk classification, not total wages. A crew paid identically, doing a mix of higher risk and lower risk work with nothing separating the two in the records tends to get reclassified upward at renewal, retroactively, not because anyone did anything wrong, because the documentation was never built to make that distinction in the first place. Certified payroll is a stricter version of the same gap. Any contractor working on a federally funded project above a fairly modest dollar threshold has to submit a weekly report under a signed statement of compliance, carrying real legal weight, documenting each worker's classification, hours, and wages against the specific prevailing rate the government set for that job and location. A payroll system that produces perfectly accurate paychecks was never built to track hours by project and by classification on a weekly cadence. Reconstructing that after the fact, under a deadline, for submission somebody has to sign, is exactly where this goes wrong for businesses that did nothing wrong the whole way through. A landscaping company owner going through his first workers' comp audit described the experience exactly right. Every paycheck had always been correct. What was missing wasn't accuracy. It was a layer of detail nobody had ever needed to track until the moment somebody asked for it. Neither of these audits is asking whether your payroll was right. They're asking a question your payroll was never designed to answer. And the only time that gap becomes visible is exactly when you can least afford it to. The fix isn't a different payroll system. It's treating that detail as part of running payroll, not a project you start after the audit notice arrives. That's a review someone else initiates on their schedule. The next kind of exposure doesn't wait for a reviewer at all. It just runs quietly in the background, on its own clock, whether anyone's paying attention or not. Most compliance conversations around payroll focus on taxes, correct withholding, timely deposits, the quarterly and annual filings, landing on schedule. That's real, and it's where most owners' attention goes, because it's the most visible part of the process. But every business that employs people carries at least two more obligations that have nothing to do with tax withholding at all, run on entirely different deadlines, and can create real financial exposure even when the payroll itself was perfect. The first is new hire reporting, a federal requirement to report every new hire to a designated state agency, generally within 20 calendar days of their start date. This has nothing to do with your tax filings. It exists to help states track employment for child support enforcement, and it applies from the very first employee a business ever hires. No size threshold, no exemption for a business bringing on just one or two people. The second runs on an even less predictable clock, and it carries considerably more weight. An income withholding order arrives when an employee has a child support obligation, and it's a legal notice, not a request. It tells you exactly how much to withhold and where to send it. Most states require you to start withholding by the very next pay period, often within 10 business days or less. There's no review period, no discretion to wait while you sort out questions. Get it wrong, misplace the notice, misjudge the amount, assume the employee will handle it themselves, and you become personally liable for what should have been withheld, on top of a separate civil penalty. That liability exists entirely apart from whatever the employee themselves owes, and it doesn't end cleanly if the employee leaves. You're generally still required to notify the agency so the withholding can continue elsewhere. Neither of these shows up on a tax calendar because neither one is a tax filing. A business that's diligent about every quarterly deposit can still be completely exposed on both of these fronts. Here's why everything we've covered so far matters together and not in isolation. A business can have flawless deposit habits and still be carrying a misclassified contractor. It can pass every workers' comp audit and still have an income withholding order sitting unhandled in a drawer. Checking any one of these areas on its own only ever gives you part of the picture. None of what we've covered so far announces itself. It sits quietly until something forces it into view. So the real question is what a business actually does about that. And that's worth talking through directly. Here's what that actually looks like in practice. And it starts with a question most owners ask first, even though it isn't the one that matters most. Most business owners who think about outsourcing payroll start with the same question. How many hours will this save me? It's a reasonable place to start. It's also not the question that tells you the most. Two businesses can spend the exact same 3 or 4 hours a month on payroll and be carrying completely different levels of risk. One of them is spending that time reviewing a system's output and approving a pay run someone else calculated. The error-prone part of the process has already been handled somewhere else. The other is spending those same hours manually keying numbers into a spreadsheet, tracking deposit deadlines by hand, hoping a rate change or a transposed figure doesn't slip through. Identical time, entirely different exposure. That second scenario is more common than most people assume. A meaningful share of small businesses are still running payroll through spreadsheets or manual methods with no dedicated system underneath them, not out of carelessness, but because there's no built-in check against the kind of small, ordinary mistake a system would catch automatically. When a mistake does slip through manual payroll, it tends to cost real money to unwind. So what does handing this off actually change? A few specific things, each addressing a different piece of what we've covered today. It removes the deposit decision entirely. A professional payroll platform, something like Paychex or Intuit, which is what most outsourced arrangements run through, calculates and submits trust fund deposits on schedule as a matter of routine. There's no moment where a deposit becomes a choice during a tight week because the process doesn't leave room for that choice to exist. It builds in the classification layer most businesses never think to track. Contractor relationships get reviewed against actual classification tests rather than left as a decision made once and forgotten. Workers' comp and certified payroll reporting, the kind that requires classification and project detail, broken out by employee, gets generated as a normal part of the process instead of reconstructed under deadline when an audit notice arrives. And it catches the obligations that don't run on a tax calendar. New hire reports get filed automatically the moment someone's entered into the system. Income withholding orders get routed and processed the moment they arrive on the required timeline, without depending on someone remembering a notice that showed up in the mail on no predictable schedule at all. There isn't one right way to structure this. Some businesses hand off the entire function, checks, filings, deposits, records, all of it. Others keep writing their own checks, but hand off the compliance layer underneath. Others want to stay hands-on and simply want the calculations and filings automated, so nothing depends on manual math. The right structure depends on how much of this an owner actually wants visibility into versus handled without having to think about it. A seal coating company owner who made this switch described it plainly. The hours weren't why he switched. It was realizing that cutting checks accurately and staying compliant with every deposit and filing deadline are two completely different jobs, and his manual process had only ever been handling the first one. The value of handing this off was never really about the hours. It's about which of today's exposures stop being a decision anyone has to remember to make correctly every single time. That's the whole arc from what actually happens to a paycheck to where risk sits without anyone deciding it on purpose, to what changes when someone else is watching all of it at once. If any part of that sounded familiar, here's what to do about it. If something in this video landed for you, if one of those areas describes something you recognize in your own business, I want to be direct about what to do with that. The free payroll compliance review isn't a sales call, and it isn't an audit, I'm not walking in with a platform to sell you or a service tier I need to hit. What I'm going to do is look at what you actually have in place today, the deposit habits, the contractor relationships, the documentation, the obligations running quietly alongside all of it, and tell you honestly where it holds up and where it doesn't. If everything's in good shape, I'll tell you that directly. If there are gaps, I'll show you exactly where they are and what closing them actually requires. What I find consistently is that the businesses carrying the most exposure aren't the ones with bad payroll. They're the ones with accurate payroll and an incomplete picture of what handled was supposed to mean. None of what we covered today requires a complicated fix. Deposit habits can be tightened in a single conversation. A classification review takes an afternoon, not a lawsuit. The gap that's expensive isn't the fix, it's the not knowing for years that there was anything to fix at all. You can call us directly at 469-742-0283 or use the link in the description to schedule time. The conversation is free. What it uncovers might not be nothing, and finding out costs you nothing to find out. If this gave you something useful, share it with a business owner who's never had their payroll looked at this way, and subscribe. We put out practical, honest financial content regularly for business owners who want to stay ahead of the decisions, not behind them. Thanks for watching. I'll see you in the next one.